As we track the interest rate side of financial conditions, we're looking at the Fed funds rate as a signal for short-term interest rates and the 10-year Treasury yield as a signal for long-term interest rates. The Fed funds rate is the anchor interest rate for short-term borrowing or short-term financing, where the 10-year Treasury yield is the benchmark for long-term borrowing or long-term financing. The Fed funds rate is controlled by the central bank, and they decide when and where to set these interest rates. On the other hand, the 10-year Treasury yield is controlled by the free market. It moves according to the supply and demand of 10-year Treasury bonds, so it conforms to the laws of supply and demand. Now let's talk about how they impact industries differently. Now, when we talk about short-term interest rates, we're talking about anything less than 10 years, where long-term interest rates are anything 10 years and beyond. Therefore, auto loans and credit cards are more impacted by the Fed funds rate, where mortgage loans are going to be more impacted by long-term rates. Now, the special thing about the 10-year yield is that they are used to value the future earnings of stocks, which makes them a key indicator for the stock market. Now, the Fed funds rate is special because it determines the interest earned on cash. So it raises or lowers the incentives to hold cash. The 10-year Treasury yield and the Fed funds rate don't always move together in unison, but the key concept is to recognize when each one of these rates is rising, which tightens financial conditions, and when they fall, which are easing financial conditions. So when they move together, it's pretty obvious conditions are either tightening or easing. But when they start to diverge is when we want to start asking questions. Why is the bond market not agreeing with the central bank? What is the free market seeing that the central bank is not seeing? The next concept we want to understand is that the 10-year yield is a forward-looking indicator compared to the Fed funds rate. And this is because the Fed funds rate only changes 8 to 10 times a year, where the US Treasury rate is trading 5 days a week. So what have we learned here? The 10-year Treasury yield sets the benchmark for longer-term interest rates, reflecting how the free market sets financial conditions. It is a leading indicator for financial conditions. The Fed funds rate sets short-term interest rates, a lagging interest rate, reflecting how the central bank sets financial conditions, reflecting how the free market sets financial conditions. Investors track liquidity because it has a tremendous impact on financial markets. And liquidity trends are probably our most useful tool for tracking the tightening and easing of financial conditions. So what is liquidity? Liquidity is the flow of money, and that flow can be directed into the financial system or out of the financial system from the government's treasury or the central bank. We want to know how to track those flows in order to capitalize on potential changes within the market. So first, we're going to start with the central bank's balance sheet, which are the total assets of the central bank. Because they can create money, they are the biggest source of liquidity. They can inject liquidity into the banking system by purchasing assets, or in other words, exchanging cash for those assets. This removes the assets from the bank and replaces it with cash that can be used to increase loan growth or buy more assets. So as the Fed's balance sheet increases in value, they are injecting cash into the system and absorbing more assets, which reflects an increase in liquidity. The Fed can also remove liquidity by doing the reverse, selling assets to banks, which would have the opposite effect, sending the balance sheet lower. And obviously, removing cash from the banking system restricts their ability to fuel or finance the economy. Next, we have the Treasury General Account, also known as the TGA. This is the government's checking account within the US Treasury. When the government collects taxes, they are draining liquidity from the economy, and that builds up in their account. They are effectively removing liquidity in circulation. The government can also reduce liquidity by issuing new treasury bills. Now, they are selling these treasury bills to raise money, but that also means they're sucking cash away from financial markets to fund the TGA. So when the TGA moves higher, liquidity is leaving the financial system. Tax collection and bond issuance are both the result of tightening financial conditions. However, when the TGA falls, the government is spending into the economy. Just think of all the government payments, Social Security benefits, stimulus bills, or whatever is passed by Congress to spend into the economy. When they spend, they re-stimulate the economy, which is an increase of liquidity. Next, we have the reverse repo, or the RRP. This tool is used by the Federal Reserve to manage liquidity for and between financial institutions. When the RRP goes up, cash is leaving the financial system in exchange for interest-bearing securities, so liquidity is leaving the financial system. When the RRP goes down, securities are being sold for cash, so liquidity is coming back into the financial system. Now, instead of trying to remember all these liquidity facilities, we can track the overall liquidity by looking at Fed net liquidity, which takes the Fed's balance sheet and subtracts it from the TGA and the RRP. So Fed net liquidity is an all-encompassing indicator that shows liquidity actions between the Fed and the US Treasury. We can also look at the supply of money, which represents pure money growth. And as our liquidity indicators increase, we should also see a correlation between the supply of money. In this chart, we're looking at Fed net liquidity, the global money supply growth, and the S&P 500. Now, this is a 4-year cycle, and what we see is when liquidity increases, the market performs. When liquidity decreases, the market underperforms. So all these liquidity indicators are how we track the central bank and the government's actions that impact liquidity as a whole. Now let's move on to the economic cycle.